All right, and we are now live. So, hello and welcome to those of you joining us just a few minutes early. My name is Charlotte. I'll be your money show host for this session. I do have Brandon here with me in the Zoom room. He is ready to begin his presentation on time at 3:25 p.m. That is Eastern time, coming up in just a few short minutes now. Thank you all so much for your patience. I hope you're enjoying the show so far. If you are looking for something to do while you wait for the session to begin, please feel free to scroll on down to CoinFlip's virtual booth. It's below the video player. You can get some more information there, reach out to their team, and you can also download a copy of the slide deck that will be used in today's presentation. It is in the download section, Unlocking On-Chain Lending and Earning, if you wanted to download that to follow along. All right, everyone, thank you so much. We'll be getting started in just a few minutes. Hello again, and welcome to anyone who's just joining us. This is your Money Show host speaking. Just popping in again to let you know that the next presentation will begin on time in a couple of minutes now at 3:25 p.m. Eastern Time. If you are looking for something to do while you wait, feel free to scroll on down to CoinFlip's virtual booth below the video player. They have lots of information down there, as well as a copy of the slide deck that will be used in today's presentation. Hello, everyone, and welcome to the session. It is my pleasure to introduce our next speaker, Brandon Sands, client manager with CoinFlip, leading their North American OTC desk. Brandon specializes in digital assets, complex decentralized finance strategies, and bridging traditional finance with cryptocurrency through high touch client support. Now, to our live viewers, please type any questions you may have throughout the session into the live chat box. Time permitting, we'll try to get to some of those at the end. And with that said, Brandon, I will hand the mic over to you. I'll be here if you need me, but the floor is all yours.
Hello, everybody. My name is Brandon Sands, and thank you for the lovely intro. So today we're going to be covering what is DeFi and what are some of the opportunities that are presented in the economy currently. And I also wanted to show some market updates. We had some really cool news come out with the SEC today. So this is a yield roundup. I'm going to highlight the top opportunities in the space as well as some credit options if you ever have any crypto and you want to figure out how to borrow against it. This presentation will help you figure out which providers you can actually go take a loan with. So DeFi yield and credit options allow users to earn interest or access capital without intermediaries. These protocols are using smart contracts to facilitate lending and borrowing, and they also provide structured financial products like yield vaults and credit lines. What's really cool about this decentralized finance space, aka DeFi, is all you need is a wallet funded with some crypto. So as long as you have this wallet, you won't need an email or a name or credit score. Everything's accessible and unrestricted. So it's kind of like a wild west of finance, so to speak. But these smart contracts are what protects users and what protects protocols. Within crypto, people do say code is law. So it's always good to work with smart contracts that have been verified and audited, and also smart contracts that have longevity. So here's some of the key components of DeFi, and also feel free to drop any questions. We're going to have some time at the end to cover those. You have DeFi lending where users can actually supply their assets to socialized or isolated pools. Essentially, it's different types of lending structures. Socialized pools are safer. You have all groups of lenders depositing into a similar pool. And then you also have a diverse set of borrowers with different forms of collateral. And those smart contracts will work to protect the lenders and make sure that the borrowers are over collateralizing their loans. So for me to give a loan to someone, they have to first put up some capital, and that is their collateral. And the smart contract will also handle the interest accruals and watch for liquidations if that does happen. So at the end of the day, lenders are protected the most in these smart contracts for lending specifically. Borrowers can access leverage against their crypto by depositing their crypto as collateral, and then they can access instant liquidity in a various set of crypto tokens. So you have stable coins, you have Bitcoin, you have Ethereum. So depending on your own personal risk and your own trading strategy, let's say I wanted to short Ethereum against my own Bitcoin, I can actually deposit Bitcoin as collateral, borrow Ethereum, and then sell that Ethereum to buy more Bitcoin. So I end up having more Bitcoin exposure and my debt is priced in Ethereum. So if Ethereum doesn't perform as well as Bitcoin, I end up having an excess profit on top of the leverage gains. Then there is market making, and this is something pretty unique to crypto. Well, there is general, traditional financial market making. You have your top brokers like Fidelity, Charles Schwab, and Merrill Lynch, and these companies are actually providing a liquid market for people to buy and sell stocks. Within crypto, there is no giant companies or intermediaries, so everything is quote unquote crowd funded. So if you actually wanted to um, earn some interest and provide the facility for people to trade, you can actually create your own mini market, so to speak, and that's called a liquidity pool. You deposit your own Bitcoin, your own Ethereum, and traders will trade between that trading pair, and you can also set your own spread. So you end up earning as people are buying and selling between the assets, and these assets have volatility. But you also, at the end of the day, own the market. So once you decide I've made this market for long enough. I can decide to actually withdraw my funds and I'll get back both my Bitcoin and ETH. The proportions may have changed and there's some nuances with risk there, but you will have earned interest as well for those trading fees. And the last and probably most commonly heard of is staking. And there are a few types of staking. I would say there's some misconceptions of what people believe staking is. So you have soft staking, and that's where you're actually depositing with like Coinbase, for example. They have some staking options on their site. However, they're not actually like they're taking your funds. Maybe they're paying you 1 to 1.5%, but the primary staking rate, if you actually go to the Ethereum blockchain and you stake with your own validator, you can actually get up to 3.5, maybe even 4%. And that's called hard staking. And that's when you're actually going directly to the blockchain and getting the true source of yield. But with Coinbase, for soft staking, it's a sort of service they provide you, and they end up taking a pretty hefty chunk of the fees. And then in the middle ground, you have liquid staking, which is my personal favorite. And that's actually where you delegate your stake tokens to a provider like Lido. A Lido is a liquid stake provider where they pool user deposits to actually then hard stake on behalf of those users. In return, those users receive a receipt token of collateral called a liquid stake token. What's really cool is this token is a tradable token. It is tradable for the underlying value of the stake. So I can have this liquid stake token, let's say staked ETH, and I can then trade against it. I can borrow against it. I can provide liquidity against it, or I can even lend it. There's a lot of different options, and DeFi works like Lego pieces where you can stack strategies on top of each other because these tokens and contracts are fully composable with each other. So here's some of the top providers for these options. So for lending platforms, we have Aave. They're currently the largest money market in crypto. You can lend your assets for a variable interest rate, but when you lend, you can then borrow. All loans in crypto have to be over collateralized. So that's why a credit score is not needed because you're not taking an under collateralized or non collateralized loan. So yeah, Aave has around $50 billion in liquidity currently. And here are some of the lending rates right now. You can lend USDC, which is a dollar denominated stable coin. It doesn't change in price. And you can lend this flexibly for a 5.16% as of yesterday when I got these figures. And what's really nice is there's no penalties to withdraw early, as well as there's no minimums. So I could deposit a tenth of a penny and I can withdraw that tomorrow. It may have not made a lot of money if there's, transactional fees when I'm actually interacting with the blockchain, but it highlights the flexibility of the system. And also, you can then lend ETH for 3.11%. And this is not staking, this is actually lending. When you're staking, you're helping actually prove transactions on a blockchain. So it's a whole different set of risk versus lending. Lending, you're actually lending to borrowers who are then posting collateral. So there's a little less risk there versus staking, where you can actually get something called slashed. Then we have also Morpho lending is up to 15% on USDC. And ETH right now, Morpho is providing 5%. And then there's a new protocol that has came on the block recently called Peapod's Finance. And Peapod's Finance is really unique in their protocol where they're actually harvesting the volatility of assets as yield. So the borrowers end up earning a lot of yield because they're leveraging their assets and they're earning from the volatility of their assets. So they also can afford to pay lenders a hefty amount. So currently, as of yesterday, there are lending strategies on Peapods between 28 to 38% on USDC lending. The same applies. There's no minimums as well as no penalties to withdraw. So if you stake for 1 month, or sorry, if you lend for 1 month, then you earn 28% divided by 12 months, and that's your interest rate for that month. They do also have some ETH lending opportunities between almost 8 to 15.66%. And we do have some yield platforms like Beefy. And I always suggest, verify these websites, do your own research. None of this is financial advice, but this is an exploration of what is in the economy and what opportunities you can take. So if you ever have any questions, you can always contact me at CoinFlip. But you can also reach out to Grok on X. Grok is actually very well trained on these crypto protocols. A lot of crypto communications happen on X, so there's a really large training set, and Grok is pretty accurate when it comes to crypto information. So Beefy and Pendle are some yield platforms that are lower risk, but Beefy provides a higher flexibility of your risk. And this is where you can actually see some market pools. So if I had Bitcoin and ETH, I wanted to provide liquidity, I can earn up to 39%. If I had ETH and USDC, I can earn up to 38%. And Pendle is unique where they actually offer fixed income opportunities, and they're one of the only platforms that offer fixed income. And these are done through crypto bonds that have an expiration date. So, for example, this bond here for SUSDE, this is from a provider called Athena. They mint the SUSDE token. You can actually bond your stable coins for 10.29%. and you'll earn that interest rate over 51 days. The same applies. There's no minimums. And if you decide to leave early, you'll earn whatever amount of time prorated by the interest rate. And they also do have a Yo ETH bond. This is a staking derivative. But there is a bond on top of that staking derivative that's lasting for 51 days. So you can earn 7.25% for that 51-day period. So I see Pendle very similar to like commercial deposits with a bank. However, you can see how it's higher yield, and there's no lockup, so you don't have to wait a full 90 days. And Pendle does offer bonds that are longer than 51 days. I've seen bonds as long as 800 days with a fixed interest rate. If you really want to get into market pool farming, that's where you would go to Uniswap or Peapods. There's some really high rates. So right now, Uniswap, if you're willing to provide ETH and USDC and liquidity, you earn 45% a year. And if you want to provide Bitcoin and wrap staked ETH in liquidity, you're going to earn 95.89% a year. But what's really cool is this 95.89% doesn't include the underlying 3.5%, 4% staking rate coming from ETH. So you're compounding yield on top of compounding yield, and that's the Lego piece effect. And with Peapods, they have some pools that are printing 135% as well as 49%. But these are with specific assets. So always do your due diligence. If you want to go after these rates, you have to understand what is the underlying asset, how's the strategy working, and if that fits within your risk tolerance. So these are the websites. I'm going to stop here for a moment, so everyone can take a look at this, maybe take a screenshot or write it down. So these are the main websites where you can actually then take a variable interest loan, and that's Aave and Compound. If you want a fixed interest loan, you can also go to Olympus DAO and Compound. So I'm going to switch screens here. And could you let me know if you guys can see this Olympus screen here?
Not just yet. We'll give it a moment. I'm still not seeing it.
Okay, let me try and change the share screen.
Mhm.
Okay, I think I got it.
Yes.
Perfect. So Olympus DAO is actually the longest running DeFi hedge fund. It was completely crowdfunded. There was no VCs or angel investors to begin with. And currently they have a treasury with a market value of $193 million, fully crowdfunded, and they've been around since 2019. So they've been running strong for 6 years, growing their treasury. And most of the treasury is stable coins. You can see here there is this stable coin called Savings USDS. This stable coin's earning around 7% underlying, and they have a $38 million position in that asset. So as they earn yield and as they enact investment strategies with the treasury, all of that goes back towards the treasury, which then backs their token. So if you do purchase their Olympus token, you will become a shareholder of the protocol. And what's nice is the protocol can actually liquidly back every token up to $11.67. So this is what's called the minimum price. If if the token did go under that price for any sort of reason, the Olympus protocol could market buy every token in existence and bring the supply to zero. And if you are a shareholder, you then are afforded the right to borrow against the treasury at 0.5% fixed interest. Then you can see here what the current loans are that are outstanding and what are the current what's the current loan capacity available. So there's $38 million in available liquidity, almost 39 million. And I've worked with some of my clients who have done some really interesting strategies. So they wanted, for example, one of my clients, he wanted to bring down his credit card interest rate, and he also wanted to buy crypto. He had some money that came his way, and he was trying to decide, do I pay off my cards or do I invest in crypto? I had told him about Olympus, and he was able to come up with a strategy where he could do both. He bought the Olympus token, and then he borrowed against that Olympus token at 0.5% to then pay off his credit cards, which were around 27%. So he was able to reduce his interest expense by over 50x. And this is saving him money on a monthly basis. Eventually, the Olympus token did perform well for him, so he then paid back that debt that he had the loan he had took out with Olympus, and he had an extra profit with the Olympus token, which then he sold and cleared out the strategy. And I'm going to come over to Compound here. Compound is really unique as well. They have isolated pools where you can only deposit Bitcoin and only borrow USDC. And they also have the socialized pool where you could deposit all sorts of different collaterals and borrow all sorts of different assets. Right now, you can borrow USDC for 3.73%. So this is unique if, for example, I don't want to buy the Olympus token. 0.5% is a great deal, but I already have Bitcoin or I already have Chainlink or ETH. You can come to Compound and get a really good flexible loan here. And they do have some some fixed interest options. But typically you will pay a slightly higher rate than whatever the current variable rate is. So you're going to lock in a higher rate. And if the variable rate does go up later, you're still locked in at that fixed rate. And I'm going to move over to Pendle just to highlight what these bonds look like here. So here, for example, is a wrap staked ETH bond, and it's earning a 3.5% fixed interest. There's $1.9 million in liquidity, and this is guaranteed for 876 days. There is some underlying smart contract risk with all of these protocols, and that basically means is there some sort of error in the code that hasn't been discovered? Is there some way that someone could withdraw funds without having permission to do so? And that risk is something that is mitigated when these protocols do something called audits. They pay for outside third parties to actually review the code. And what's also nice is the code is open source. So if you are someone who's technically inclined, you can actually verify the code yourself, read through the code, and see how it works, and then come to your own conclusion of the risk. And something I have seen is with protocols like Pendle, Uniswap, and Aave, there's billions of dollars inside of these contracts. So there is an economic incentive to try and poke a hole through these contracts. There's been a lot of crypto hacks, especially coming from the North Korean group Lazarus. And when I see a contract has been around for long enough with billions of dollars, to me, that longevity of the contract is also de-risking the contract over time because that means no one has found an exploit yet. So if these contracts run for the next 100 years without an issue, then I would assume comfortably that the next 100 years after that, there also wouldn't be an error because these contracts are unchangeable and they're immutable. So that's an example of what the Ethereum bonds are. And there are some Bitcoin bonds as well. But the yield is lower because there's a lot of capital locked in Bitcoin. And Bitcoiners are pretty hungry for yield. So here you see if you're willing to hold solve BTC.BNB, this is a wrapped Bitcoin derivative that's provided by Solve. But if you have this Bitcoin derivative, it's supposed to be backed one-to-one with Bitcoin. You should do your own due diligence to see how Solve is backing their token. But it is a tradable synthetic of Bitcoin, and you can bond this for 134 days for a guaranteed 2.44% interest rate. It's what's nice is you're earning this interest rate in like kind. So if you deposit Bitcoin, you're earning Bitcoin. If Bitcoin doubles the next year, your dollar interest rate, so to speak, also did double over that course of the year. And what's nice about Pendle is you can also search by fixed APYs and go for the highest, or maybe by liquidities as well. And you can see there's $100 million pools here as well. And I'm going to quickly highlight Morpho. So Morpho is another earning strategy. And what's pretty cool about Morpho is this is a site where users can create their own fund. And there's these curators who manage the fund. And you can see here all the list of different curators. And what is the collateral they accept for that fund? They then will, on behalf of you, use those tokens as collateral to then access DeFi opportunities like Pendle, like Compound, like Peapods, and they'll earn you an interest rate. But their goal is obviously to mitigate risk and to earn as high of yield as they can while mitigating as much risk as possible. And here's some of the rates right now that these funds are earning. And this is depending on all sorts of different assets. So we could see this 9% fund right here is a slew of different assets, Ethereum, stable coins, and probably some other another stablecoin derivative there. So there's some underlying risk in each of those tokens. You have to understand who is the provider and issuer of those tokens and how are they maintaining the backing of that token. But once you do your research and it's something you're comfortable with, you can easily access these sites and try out a deposit of $1, $5, $10, or if it's comfortable for you, 1,000. And on the top right here, you can see I have my wallet connected. All these sites are super interoperable with your wallet. So here's an example with Pendle. I could just click connect wallet up here, and I guess the site is having a little lag because I'm sharing my screen, but I wouldn't typically be able to just connect my wallet very easily as I was able to connect with Morpho. And you can see here I'm also connected with Compound, and I could also connect with Olympus DAO, and it's pretty standardized how these decentralized applications work. And lastly, I'm going to give a little highlight on Beefy. These are all the market making pools that you can access with Beefy. And Beefy will actually auto allocate the yield and auto compound for you. So as you're earning trading fees, it'll then roll that back into the position so your market starts growing in depth and gets bigger and bigger. So you can actually provide more efficient trades and settle larger orders, hence earn more fees. So if I wanted to look at blue chips that were correlated, this is like a Coinbase ETH and Wrapped ETH. I could farm this pool for 9%. But let's say I wanted to do stable coins alone. There's all sorts of different stable coins. So these stable coins are a lot less known by the overall market. So that's why they're earning a higher rate, 67 or 62%. But let's say we find like this pool, USDS. This is a single side pool earning 17%. And this pool actually has around 54 million. And what you see here about the 8 million is the portion of the pool that Beefy's managing. So it's really cool how you could see the pool is really transparent. Everyone can see what the deposits are, and Beefy will show you this is the amount that we're managing on behalf of users, and this is the total amount that users have deposited across the space. And lastly, I just wanted to highlight a new update. This just came out today from the SEC on their official website. They're talking about liquid staking and how they view liquid staking. There's a lot of developers and founders that have moved their crypto projects outside of the US because of the hawkishness that the previous administration was showing towards crypto. And there wasn't a lot of guidance. And honestly, we were stifling innovation that we could have had here in America. So now with the new administration, they just passed the Genius Act, which gives a lot more regulatory clarity about stable coins. And now they're working on what's called the Clarity Act, which then will give more information about the requirements of DeFi protocols to stay legally compliant. But as you can see here, it says that the division, the SEC does deem liquid staking activities to not involve the offer and sale of securities. So they're essentially saying they don't see liquid staking as a security sale, as a security strategy. So this is a huge win for the space. A lot of the developers who were working on some of the largest liquid staking protocols, billions of dollars of liquidity, they had to move abroad. So now this is giving us a vote of confidence that we can bring back this innovation to the US. Now I'm going to come back to the presentation here. All right, and just let me know once this catches up with everybody else.
Yes, we can see.
Okay, great. So yeah, here are some of the risk considerations with these strategies. As I mentioned, smart contract risk is an underlying risk with every crypto protocol that is a decentralized finance protocol. Since there is no intermediary, since there is no centralized authority, we put our trust in code, we put our trust in contracts and mathematics, rather than putting our trust in people and government systems that have historically failed in the past. So there's also impermanent loss, which is a specific risk to market making strategies. As I mentioned, you have this balance between Bitcoin and Ethereum within a pool. You actually have to keep that balance in 50-50 ratio. So if I put $10,000 of Bitcoin, I have to also put $10,000 of Ethereum. If Bitcoin starts to appreciate in price, what's essentially happening is traders are coming into my pool, they're depositing ETH to then buy Bitcoin from me. So then I lose a little bit of Bitcoin that I then hand off to the trader and I take their ETH in exchange. So then if Bitcoin pumps and then tomorrow I decide to withdraw, there's going to be a slightly different ratio of the actual units. However, the dollar amounts will be equal. So if I had $10,000 of Bitcoin, $10,000 of ETH, I might have $11,000 of both assets now. However, maybe I had deposited 0.1 Bitcoin, but now I'm only withdrawing 0.9 because Bitcoin had appreciated and now 0.9 Bitcoin is worth $11,000. So this is not a real loss. It's not a real risk, so to speak. But this is the opportunity cost essentially, because you may have actually performed better if you just held Bitcoin and Ethereum in your wallet and you never provided liquidity. But your goal is if you're providing liquidity, the excess interest you're earning from the trading fees, you can use that interest to then repurchase Bitcoin or repurchase ETH if you had a little less after ending the strategy. If that interest can cover the amount that you had less of, then that's your profit on top of providing this market liquidity. So it's just something to keep in mind if you're deciding, should I go for a market making strategy or should I just go for a buy and hold or for a leverage strategy? And for leverage strategies, we do have a liquidation risk. So if I have like $100,000 of Bitcoin on Aave, they let you borrow up to 70% against your Bitcoin, 70% LTV. So if I deposit 100 grand, I can borrow $70,000 of USDC. I can use this USDC to pay my bills, pay off my car, or pay off my house, whatever I'd like to do. But essentially, if Bitcoin's price retraces, let's say like 25, 20%, I have a really high leverage loan. I borrowed a lot against my asset. There will be a point that your position will be open for liquidation, where essentially an outside liquidator will, to protect the socialized pool, they don't want bad debt. They're going to cut your position before the Bitcoin is worth less than your debt. So this liquidator, they're incentivized to actually purchase your debt to then claim your collateral, whatever that small difference in profit is. That's their liquidation fee for keeping Aave safe. But at the end of the day, you took a $70,000 loan, so you don't have to pay that back. You already have that loan in your possession. But you would lose your Bitcoin if you did take a really high risk loan and your Bitcoin did drop in value. So it's just something to keep in mind. Um, it's probably a lot better and safer for users if they are borrowing against their assets on protocols like Aave and Compound to stay within like a 30 to 40% range. At like 30 to 40%, Bitcoin would have to drop to around $40,000 to $50,000 for you to get liquidated. And yeah, DeFi, yield, and credit protocols are reshaping capital markets by removing the middlemen, as I have mentioned. And we see an increased efficiency in the space because of this. And new opportunities are being created every day. So it's important to manage the risk and use proper tools available to you to actually verify these protocols. And I actually would like to show one more site. And this is one of the best research sites I have came across. It's called DeFi Llama. And what's really nice about DeFi Llama is it's watching all the top blockchains with all the different DeFi activities. And you can actually see in real time what are the trading volumes, what are the total value locked, meaning how much inactive loans, borrows, deposits, market pools, like what's the total value that's actually like staked, so to speak, and then what's the actual volumes being traded through these markets. And if we come over to chains over here, we can actually see a nice pie chart of where this liquidity lies. And as you can see, Ethereum is around 60% of the total DeFi TVL. So if you have $100 million trade and you want to do this unrestricted anonymously, you're probably going to get the best pricing on Ethereum because they have $81 billion of liquidity to help you source pricing. And what this tells me is that Ethereum is hitting a sort of network effect, similar to what we saw YouTube and Facebook hit early on in the early days of the internet. And even with other social media platforms coming about, these giants like Facebook and YouTube still, at the end of the day, are the giants because they hit the network effect and users trust them, and users show up daily to use these protocols. And especially with Ethereum, users are actually using their money. So they're putting their money where their mouth is, and they're spreading Ethereum and the actual protocols by word of mouth. So it's really cool to see how this space has evolved. There is no marketing team for DeFi. Everything is a grassroots effort, and there are projects that have VC funding, but overall, DeFi is something that is brings power back to the people. So here's my contact information. You can actually, that's my personal number there. So feel free to shoot me a text, or if you'd like, you can shoot us an email. I'll be able to handle that as well. And if you want to check out our website, it's coinflip.tech. And we do have our OTC desk, which is otc.coinflip.tech. So if you want to be able to buy and sell in higher amounts, we can facilitate those trades via wire transfer or ACH. And anyone who signs up with the OTC desk can actually get one-on-one access with me to have a free session once a week where we cover DeFi. I can share you my research, and you can basically ask any sort of questions you may have about this ever-evolving space. So thank you very much for your time today, guys. I will take any questions from the chat. So I'm going to open it up here.
Thank you, Brandon. We have a couple of questions here in the chat. I know we're short on time, but I'll try to just breeze through them. Theodore had asked if you have any cryptocurrency recommendations. Do you recommend one over another?
So I'm not allowed to give financial advice, but I will say when it comes to picking a cryptocurrency, the first things you should look at is what is the purpose of the cryptocurrency and are they revenue generating? Because crypto is like a stock market of assets. You can still look at crypto in the same way that you would look at a stock. There is an income statement, there is costs and expenses, but there's also revenue and users. So DeFi Llama would be your best friend to find out which of those protocols are revenue generating, and then you can look into how they bring that revenue to their token.
Thank you, Brandon. And Ron in our chat had asked, do you think staking will be allowed in California soon?
Well, after the SEC just releases today, I would say that California would fall behind if they're not allowing staking. But if it's federally legal, it should be legal on a state level. So I would, talk to your accountant to be sure. However, I believe staking will be legal in California. But also there is the caveat that all of these systems are anonymous. So if you bought crypto and you started staking, no one really would know you're doing that. But it is your obligation to report your taxes at the end of the year.
Thank you, Brandon. I'm going to give you this last question here from Brittany. She's wondering how she can get started. Would that just be going to that coinflip.tech?
Yes, so otc.coinflip.tech would be best for starting with our OTC site. This is where users can actually get in contact with me and create their account. It's free to do so. And there is no minimums. And it's a very simple OTC exchange. We don't hold client crypto on balance. We actually just send the crypto straight to your cold wallet. So if you've worked with Coinbase and Kraken before and you have had to wait 7 days or 14 days to withdraw and they're just freezing your money, you won't have that experience with us. When we get your wire transfer, we actually will then send the crypto out to your personal wallet within 1 hour. So here's the website for anyone to come check us out. And you can put my name, Brandon Sands, as the referral. We'll make sure to get you a discounted rate as well.
Well, thank you so much, Brandon. To those of you watching live, I did go ahead and put that link into the live chat for you. But you can also scroll on down to CoinFlip's virtual booth below the video player and get some more information that way, and also gain access to their website through the links that are available there. Thank you all so much for joining us. Brandon, it's been a pleasure having you on. And to those in our live audience, be sure to stay tuned as we have a lot more in store for you in this Money Show Virtual Expo.
Thank you, everyone. Cheers.
I hope everyone has a wonderful rest of your day. Take care.